Investment. Ladies and gentlemen, today we stand at a crossroads in American finance. The national debt is no longer a distant figure in textbooks. It's a real investment, pressing challenge that affects everything from the price of goods to interest rates on loans, from government programs to the stability of our financial system. With the US debt clock ticking ever higher, the question arises, how does a country this big, this powerful, navigate its financial obligations without jeopardizing its future? Historically, governments have leaned on a few standard tools: raise taxes, cut spending, or borrow more. Each of these measures has its consequences. Raising taxes can slow economic growth and burden everyday Americans. Cutting spending might hit vital programs that millions rely on. Investment. Borrowing more, while tempting, can lead to an even larger mountain of debt that becomes harder to manage over time. The traditional playbook, while useful in certain contexts, may no longer be enough in today's global investment, highly interconnected economy. Enter the world of cryptocurrencies. Once dismissed as a niche interest for tech enthusiasts, crypto now commands the attention of investors, corporations, and even governments. Some see it as a potential lifeline for managing large-scale debt. Could blockchain technology, stablecoins, or even a government-backed digital currency offer innovative ways to restructure debt, attract investment, or provide liquidity without relying solely on traditional financial instruments? While the promise is tantalizing, it's important to approach it with a grounded perspective. Crypto is volatile. Its regulatory landscape is still evolving, and large-scale adoption, particularly in a system as entrenched as the US economy, will take time and careful planning. Still, there's an undeniable opportunity here. By exploring crypto intelligently, the US can experiment with new forms of value transfer, encourage private investment, and potentially unlock solutions that were previously unimaginable. For investors and citizens, this is a chance to think creatively about wealth preservation and financial resilience. For policymakers, it's a prompt to blend innovation with prudence, leveraging emerging technologies to support long-term fiscal health. At the end of the day, America's debt dilemma is not just a numbers problem. It's a question of strategy, foresight, and adaptability. It may not be a silver bullet, but it could become one of the tools in a broader toolkit to manage debt responsibly, empower citizens, and maintain the country's financial strength. And navigating this challenge will require careful thought, bold experimentation, and an openness to ideas that might have seemed radical only a few years ago. The path forward is not simple. Investment. But with smart choices and informed action, America can face its debt dilemma head on and come out stronger on the other side. America's national debt has grown into a massive and complex challenge, one that touches every corner of the economy and affects the lives of ordinary citizens in ways that are often not immediately visible. At its core, national debt represents the cumulative amount of money the government owes to creditors, both domestic and international. While borrowing is a normal part of fiscal management, allowing governments to fund programs, infrastructure, and emergencies, the scale of America's current debt is staggering. As of today, the national debt has surpassed levels that were once thought unimaginable. Investment, growing faster than the economy itself and creating pressures that ripple through financial markets, interest rates, and the overall stability of the system. This accumulation of debt is not just a number on a balance sheet. It has tangible consequences for taxpayers, businesses, and the nation's global economic standing. Historically, the U.S. has experienced periods of both high and low debt, often corresponding with wars, recessions, and large-scale economic projects. While post-World War II, America managed to reduce debt as a percentage of GDP through robust economic growth. The pattern over the last few decades has been concerning. Federal spending has consistently outpaced revenue, investment driven by entitlement programs, defense expenditures, healthcare costs, and emergency measures during crises such as the financial meltdown of 2008 and the COVID-19 pandemic. Each intervention was necessary in its context, yet cumulatively, they have pushed debt levels into uncharted territory. Unlike a household or business that can adjust spending quickly, investment, the federal government's obligations are enormous and often politically difficult to reduce, creating a slow, moving but persistent problem. The implications of such debt are multifaceted. One immediate concern is interest payments. The government must allocate a significant portion of its annual budget simply to service debt, meaning money that could otherwise be used for education, infrastructure, or healthcare is instead paid to creditors. This creates a strain on public resources and limits flexibility in fiscal policy. Additionally, high debt levels can impact investor confidence, leading to fluctuations in bond yields and borrowing costs. If markets perceive debt as unsustainable, borrowing rates could rise, compounding the problem and potentially triggering a cycle of debt dependence that becomes increasingly difficult to escape. Even small shifts in interest rates can have enormous effects when the debt is measured in trillions of dollars. Beyond these immediate concerns, there is the longer-term effect on economic growth. High debt can crowd out private investment as the government borrows more from the financial system, leaving less capital available for businesses to expand, innovate, and hire. This can slow productivity gains and reduce overall economic dynamism. Moreover, there is an intergenerational impact. Future taxpayers may inherit the responsibility for repaying obligations that were accumulated long before they were active participants in the economy. This raises ethical and policy questions about fiscal responsibility and sustainable growth. The complexity of America's debt situation is further heightened by the global role of the US dollar. As the world's primary reserve currency, the US has the unique ability to borrow extensively from international markets. While this provides some leverage, it also introduces risks related to global financial stability and geopolitical considerations. Currency fluctuations, trade imbalances, and foreign policy decisions all intersect with debt management investment, creating a web of interdependencies that makes any simplistic solution inadequate. In essence, America's debt is more than a financial statistic. It is a systemic issue that influences policy decisions, investment, economic opportunities, and the country's long-term strategic positioning. Understanding the scale and ramifications of this debt is crucial for anyone who wants to grasp the challenges facing the U.S. economy today. Investment. It is a problem that demands thoughtful analysis, disciplined management, and innovative approaches, because how the nation navigates this financial reality will shape economic conditions for decades to come. The choices made now will not only determine the stability of markets, but also the prosperity and financial freedom of everyday Americans. When it comes to addressing America's mounting debt, policymakers have traditionally relied on a few familiar strategies: raising taxes, cutting government spending, or borrowing more. Each of these approaches carries its own set of advantages and challenges, but in today's economic climate, they may not be enough to solve a problem of this magnitude. Raising taxes is often seen as the most straightforward way to increase revenue, yet it comes with significant trade-offs. Investment. Higher taxes can slow economic growth by reducing consumer spending, discouraging investment, and placing an additional burden on households already navigating rising costs. Businesses in particular, investment may respond by limiting expansion, reducing hiring, or passing costs onto consumers, which can stifle overall economic momentum. Politically, raising taxes is also a contentious issue, with policymakers frequently hesitant to implement measures that may be unpopular with voters or seen as punitive. Cutting spending represents another traditional lever, but it is far from a simple solution. Government expenditures cover a wide array of essential programs, including healthcare, social security, education, defense, and infrastructure. Reducing funding in these areas can have serious societal consequences, affecting millions of Americans who rely on public services. Moreover, cutting spending often encounters political resistance as constituents demand continued investment in programs that are vital to their daily lives. The challenge is further complicated by the fact that discretionary spending makes up a relatively small portion of the federal budget. Mandatory spending, such as entitlement programs, investment is much more difficult to alter without significant reform. Even targeted cuts may only scratch the surface of the overall debt problem, leaving policymakers searching for more comprehensive solutions. Borrowing more is often viewed as a temporary fix, allowing the government to continue funding operations without immediately raising taxes or reducing programs. In practice, however, this approach can exacerbate the underlying problem by increasing the debt burden and adding to future interest payments. While borrowing can be sustainable when used for productive investments that stimulate economic growth, relying on debt to fund ongoing expenditures without corresponding increases in revenue can create a cycle that is difficult to break. Over time, the accumulation of debt can raise concerns among investors, potentially driving up interest rates and creating pressure on the government to adjust fiscal policy under less than ideal circumstances. The challenge is made even more complex by the modern economic environment. Globalization, technological innovation, and demographic shifts have transformed the way economies operate, and strategies that may have worked in the past are not guaranteed to succeed today. The U.S. Investment. Economy is interconnected with international markets in ways that make fiscal adjustments more sensitive to external pressures, from currency fluctuations to trade imbalances. Furthermore, unexpected events such as recessions, natural disasters, or global health crises can place additional strain on public finances, reducing the effectiveness of traditional debt management strategies. Ultimately, the traditional tools of fiscal policy, raising taxes, cutting spending, and borrowing more, remain important components of debt management, but they are no longer sufficient on their own. Investment. Policymakers must consider innovative approaches that go beyond the conventional playbook, exploring new methods of generating revenue, optimizing expenditures, and leveraging emerging technologies. The challenge lies not just in addressing the numbers on a balance sheet, but in crafting solutions that support sustainable economic growth, maintain public trust, and provide flexibility for future generations. Investment. By recognizing the limitations of traditional solutions and embracing a more strategic and forward-thinking approach, the United States can begin to chart a path toward fiscal stability that balances responsibility with opportunity, ensuring that debt management supports rather than hinders long-term prosperity. As America grapples with its ever-growing debt, the conversation has increasingly turned toward unconventional solutions, and one of the most intriguing possibilities lies in the world of cryptocurrencies. Once dismissed as a speculative fringe asset, digital currencies have evolved into a global phenomenon with potential implications that extend far beyond individual investors. The question is whether crypto could serve as a meaningful tool to help address national debt challenges, either directly or indirectly. While the idea may sound ambitious or even radical, it's worth exploring the mechanisms, opportunities, and realities that make crypto a potential alternative in the context of America's financial pressures. At the most fundamental level, cryptocurrencies operate on decentralized, blockchain-based networks, which allow for secure, transparent, and rapid transactions without the need for traditional intermediaries. This technology has already begun to disrupt sectors such as banking, finance, and cross-border payments, offering faster settlement times and reduced costs compared to conventional methods. Investment. For a government facing significant debt obligations, these characteristics present intriguing possibilities. A digital currency system, whether fully public, partially government-backed, or integrated with existing financial frameworks, could potentially improve the efficiency of tax collection, streamline transfers of funds, and reduce administrative overhead associated with debt management. Theoretically, such efficiency gains could free up resources and create new avenues for revenue collection that were previously unavailable. Beyond operational efficiency, crypto may also present opportunities for debt management through investment and capital inflows. Cryptocurrencies, particularly well-established ones like Bitcoin or Ethereum, have captured the attention of both individual and institutional investors worldwide. By strategically leveraging these assets, governments could explore innovative financial instruments or investment vehicles that supplement traditional debt solutions. For instance, issuing government-backed digital bonds or integrating blockchain technology into existing securities markets could attract a new class of investors seeking exposure to digital assets. This approach would not eliminate debt, but it could provide alternative funding streams that complement traditional borrowing while engaging a technologically savvy investor base. There is also the consideration of stablecoins or central bank digital currencies, CBDCs, which are pegged to a government's fiat currency and designed to minimize the volatility typically associated with crypto markets. These digital assets could provide a bridge between traditional monetary policy and emerging financial technologies, offering the potential to improve liquidity, increase transparency in transactions, and enhance control over money supply in a highly digitized economy. By integrating CBDCs or other regulated digital currencies into fiscal operations, policymakers could create tools that simultaneously support innovation, mitigate risk, and address pressing debt challenges in a forward-looking manner. However, investment. The potential of crypto as a debt management tool comes with significant caveats. Volatility remains a core concern, as rapid price swings can undermine stability and introduce new forms of financial risk. Investment. Regulatory uncertainty is another hurdle, as governments around the world continue to grapple with how to define, monitor, and tax digital assets. Adoption at scale is not guaranteed, and public trust is still in the process of being earned. These factors mean that while crypto may offer exciting possibilities, it cannot be seen as a standalone solution or a quick fix to the debt dilemma. Instead, it should be treated as one element within a broader, diversified strategy that includes traditional fiscal tools, policy reforms, and economic growth initiatives. In essence, cryptocurrencies provide both a challenge and an opportunity in the context of America's debt situation. They offer innovative mechanisms for financial management, capital attraction, and operational efficiency, while also demanding careful navigation of volatility, regulation, and adoption hurdles. For policymakers, investors, and citizens, this means approaching crypto with curiosity, caution, and strategic intent. When leveraged intelligently, these emerging technologies could play a complementary role in addressing the nation's debt, helping to modernize financial systems and potentially unlock new pathways to fiscal stability. While it is not a panacea, it's a good investment. The integration of crypto into the conversation about America's debt represents an evolution in thinking, one that embraces innovation without losing sight of the practical realities that govern economic policy. If you want, I can now exwile the potential of cryptocurrencies to support America's debt strategy is compelling. It is equally critical to understand the risks, realities, investment, and practical considerations that come with integrating these digital assets into a national financial framework. The excitement around crypto often highlights innovation, rapid growth, and the promise of transformative solutions. But behind this promise lies volatility, uncertainty, and regulatory complexity that cannot be ignored. For policymakers and investors alike, success depends on balancing enthusiasm with prudence, embracing innovation while managing the inherent risks, and approaching the idea of crypto as part of a broader, disciplined strategy rather than a standalone solution. One of the most obvious challenges is volatility. Unlike traditional assets or government-backed securities, cryptocurrencies are notorious for dramatic price swings. Bitcoin, Ethereum, and other major digital currencies have experienced sudden gains and losses that can reach double-digit percentages in a single day. This level of unpredictability poses a risk for any institution seeking to use crypto as a tool for managing debt or financing public projects. While potential gains are significant, so too are the risks of loss, which could undermine the stability that policymakers strive to maintain. Relying solely on crypto without mechanisms to mitigate this volatility would be imprudent, making it clear that digital assets are best considered as a complement to, rather than a replacement for, traditional fiscal tools. Regulatory uncertainty further complicates the integration of crypto into national debt management strategies. Governments around the world are still grappling with how to classify, regulate, and tax digital currencies. Inconsistent rules across jurisdictions create a landscape where compliance is complex and potentially costly. For the United States, implementing crypto-based solutions for debt management would require careful coordination among regulatory bodies, lawmakers, and financial institutions. Ensuring transparency, protecting investors, and maintaining economic stability are priorities that cannot be compromised, and any misstep could lead to legal disputes, market disruption, or a loss of public trust. Clear, consistent regulations are essential to provide a foundation upon which crypto-based strategies can be safely built. Adoption is another crucial factor. For crypto to play a meaningful role in addressing national debt, it must gain acceptance among investors, institutions, and the public. While awareness and interest have grown dramatically in recent years, full-scale adoption faces hurdles ranging from technical literacy to skepticism about the long-term stability of digital currencies. Public education, infrastructure development, and incentives for adoption are necessary to bridge the gap between potential and practical application. Without widespread acceptance, even the most innovative crypto initiatives risk remaining niche experiments rather than scalable solutions capable of influencing national financial health. Despite these challenges, there is a clear path forward. Policymakers can explore hybrid strategies that combine the strengths of crypto with the stability of traditional financial instruments. For example, central bank digital currencies and stablecoins offer mechanisms to leverage blockchain technology while mitigating the volatility of standard cryptocurrencies. Strategic pilot programs, regulatory sandboxes, investment, and gradual implementation can allow governments to test digital currency applications in controlled environments, learning what works and adjusting policies accordingly. At the same time, investors and institutions should approach crypto with a long-term perspective, integrating it into diversified portfolios rather than chasing short-term speculation. Ultimately, investment addressing America's debt dilemma requires both innovation and discipline. Cryptocurrencies represent an opportunity to modernize financial systems, enhance transparency, and explore new mechanisms for investment and capital management. However, these opportunities come with real-world challenges that demand careful navigation. The key is balance, embracing the potential of crypto without overlooking the risks, combining emerging technologies with traditional fiscal strategies, and maintaining a focus on sustainable, long-term solutions. By approaching this issue with clarity, caution, and strategic intent, America can explore the possibilities of crypto while safeguarding economic stability, creating a pathway that blends innovation with responsibility and ultimately positioning the nation to manage debt in a forward-thinking and resilient manner.